everybody, and welcome to the first of this series of webinars on investing outside the mainstream. What we're going to be looking at in today, tomorrow, and Wednesday's sessions are three important parts of the investment process, but those which are more difficult to accommodate in the way in which managed accounts are so often managed. We're going to be talking today about investing in illiquid investments. Tomorrow, we're going to be talking about private markets. And then on Wednesday, with a number of portfolio managers, we're going to be drawing together the threads of how to actually incorporate these issues into portfolio management in a managed account context. I won't introduce today's speakers because our host for today and tomorrow, Paul Saliba, will do that. But before I hand over to Paul, let me just share with you a couple of the upcoming events which we have for IMAP. So most importantly, in July, we'll be hosting our Advice in Action conference. This will be an opportunity to look at the way in which advice is being transformed by the themes of professionalization and, importantly, digitalization, the way in which advice is becoming a digital technology-powered service, and the way that's playing out both in small ways and large. With our principal sponsor, Centric, we'll be looking at advice and advice practices and the licensee process. But of course, it's also the time for us to run the IMAP Managed Account Awards. Those entries are now open, and I'd encourage those of you who are proud of the managed account process that you follow to enter the awards. The categories this year are the asset class categories: Australian equities, small caps, fixed interest, multi-asset class, international equities. Also, the licensee category, the innovation category, responsible investing, and this year also boutique licensees. An opportunity for those licensees with less than 70 authorized reps to showcase how they use managed accounts in the way they articulate their managed account process, their investment philosophy. All of these webinars are, of course, intended to be interactive and intended for you to have the opportunity to ask questions. So I'd encourage you to take that opportunity throughout the session as we proceed. So now let me hand over to Paul Saliba, our host for today, and ask him to introduce our presenters. Thanks, Paul.
Good morning, and thank you, Toby, and welcome everybody. Today we're talking about those sort of assets that are perhaps a whole lot more illiquid to things we're used to. Industry super accounts for nearly 2/3 of Australian superannuation assets. And most of these funds have meaningful exposure to unlisted private assets with varying degrees of liquidity. So does this mean retail investors should also have exposure to these types of investments? And if so, how can the industry facilitate this? To discuss this and more is John Julian, Managing Director in Dexus's infrastructure business, and Michael Karagianis, who heads up the investment consultancy at JANA Investment Advisors. So first of all, I'll ask John to talk to how Dexus and their team enables access in this area. Thank you, John.
Thanks, Paul. Great to be here with you, Michael and Toby, today. So what I thought I might do is make a few comments as really, I guess, a segue to the panel discussion which follows, because I think that's actually going to be really topical and hopefully really interesting for attendees. But just as background, Dexus is a leading Australasian integrated real asset group which manages a high-quality real estate and infrastructure portfolio valued at over $57 billion. We've got over 4 decades of expertise in real estate investing, and with the acquisition of the AMP Capital Infrastructure business, 35 years of experience in infrastructure investing. I personally sit on the infrastructure side of the business, and I thought it might be useful to provide a bit of background on the asset class ahead of and to set the scene for the panel discussion, which, as I say, I think will be very topical and interesting. Most people probably, are pretty well aware of infrastructure assets and what they are, but essentially they're assets that provide or facilitate the provision of essential services, which help drive economic growth and, importantly, underpin the day-to-day operation of society. It includes a really broad range of assets, including things like social infrastructure, such as schools and hospitals, utilities like water and electricity, transport infrastructure, such as roads, rail, airports and seaports, and also communications infrastructure, such as mobile phone towers. As I say, infrastructure enables our society to function on a day-to-day basis, and most, if not all of us, would actually use infrastructure multiple times every single day. I think, speaking broadly, infrastructure can offer some very attractive investment characteristics in a portfolio. It can provide consistent returns with relatively low levels of volatility through market cycles because of the essential services nature of the assets. So they're assets that people have to use every single day. Secondly, infrastructure can provide consistent long-term income yields with inflation protection, and that's because infrastructure asset revenues are often underpinned by regulation or long-term contracts, which can run in some cases for 30 years or more. And then thirdly, infrastructure can provide diversification, as the infrastructure asset class, and unlisted infrastructure particularly, has shown traditionally low levels of correlation with many other asset classes, meaning its inclusion in a portfolio is an effective means of reducing overall portfolio risk levels. And then the infrastructure asset class is also actually exposed to some of the biggest structural growth themes we're likely to see in our lifetimes. I'm referring to things like the global energy transition, the ageing demographic we're seeing in developed markets, digitisation, and so on. There are really 2 main ways that investors can invest in infrastructure assets. They can invest in unlisted or direct infrastructure, or they can invest in listed infrastructure, so securities that are listed on a stock exchange. Both approaches typically invest in the same types of underlying assets. However, each of those 2 investment approaches has its own differentiating characteristics and can have different implications to a broader portfolio. As an example, some of the major benefits of listed infrastructure include diversity and liquidity. A diverse portfolio of infrastructure securities can be acquired and conversely sold in a short space of time on listed exchanges. However, listed infrastructure tends to be more impacted by market sentiment, and that means valuations are volatile relative to unlisted infrastructure, so it's not as effective as unlisted infrastructure as a diversifier in a portfolio. Some of the major benefits of unlisted infrastructure include stability of valuation or low volatility, and that's because, as I just said, unlisted assets are not as exposed to the speculation that occurs on listed exchanges. And another benefit's control, which is important as it provides significant opportunity to drive value and manage risk in an asset through your active asset management approach. However, on the flip side, unlisted infrastructure is relatively illiquid and usually requires a large capital outlay. So in our role at Dexus, we provide our investors with access to unlisted real assets and then look to manage those assets really well to deliver value to our investors. From an investor perspective, our business is mostly focused on the institutional investor market, although topically we do also have products that provide exposure to unlisted infrastructure and real estate too, which are actually specifically designed for both the retail and the wholesale segments of the market. So I hope that's a useful segue into what we'll be discussing during the panel session, and I might just leave things there for the moment, Paul, and look forward to jumping into the detail during the panel discussion.
Terrific, thank you. And Michael, if you can have your opening statements.
Yes, thanks, Paul. And look, thanks for the promotion as well to Head of Investment Consulting. My boss will be particularly pleased about that one. But I do head up the wealth client channel at JANA. And basically we focus particularly on consulting services to private wealth and advice practices, as well as family office type clients. And I guess in that context, people may have varying degrees of knowledge about JANA. We're Australia's largest investment consultant. Traditionally, we have worked very heavily into the industry fund sector. But over the last few years, we've increasingly diversified into what we call diversified clients, which covers a whole raft of non-industry fund superannuation type clients, including not-for-profits, family offices, and so on and so forth. So this issue is really important because philosophically, we have always taken a view with our clients that there is an illiquidity premium that can be demonstrated by investing clients' money in less liquid strategies. The cost of liquidity is not inconsequential. And while liquidity may be an important, even essential part of many clients' portfolios, in fact, our observation tends to be that clients probably give up too much for liquidity. And if they thought about really what their necessary liquid requirements are, and there is the capacity to actually lock away money for a much longer period of time. And I'm not just talking about institutional clients here. In fact, I'm talking about high net worth family offices and even retail clients. And curiously, even retail clients understand this because, of course, they invest in residential property quite happily and understand that it does involve lockup. But when we start to talk about perhaps a broader remit in terms of less liquid strategies, there's a lack of familiarity or less comfort with that. And I think that's probably got a number of aspects to it, and we can flesh out some of those in the discussion forum. I think complexity is one aspect of it. Some strategies can be very complex, not necessarily knowing or having tangibility of the underlying assets, particularly if you're working through a trust structure. People, do tend to like to be able to go and touch the bricks and mortars that they might be investing in. That's not quite as possible when we talk about less liquid strategies, depending on their breadth. But there also can be complexity in the way we see certain trust structures set up. There might be internal leverage associated with them. There might be performance fees associated with them. The inherent types of strategies, particularly if we're talking about, multi-strat hedge funds, for example, can be quite complex and can actually act as a bit of a disincentive for some investors and indeed for advisors to actually recommend those strategies. Cost can be a factor as well, particularly as we look at these strategies being made available to perhaps smaller wholesale investors, even retail investors. Fund managers can start to increase the cost load quite considerably. Some of that may be justified, maybe some of it may be less justified, but that can act as a bit of a disincentive also. And I think, as I said at the outset, just having that access to liquidity can provide a lot of investors with comfort. Interestingly enough, while we talk about the distinction between, say, industry funds and retail investors, we do need to remember that actually the principal investors in industry funds are retail investors. That's members' money that is being managed as a pool. So there is the power of investment from pooling investments in this space. And obviously managed accounts are just another type of mechanism by which we can potentially pool. So it is a worthwhile consideration in portfolios. The problem that we do see is that while we are philosophically very favorably disposed to incorporate less liquid strategies within managed account structures, within retail advised portfolios, from a practical dimension, it can produce a lot of difficulty. And in fact, a lot of managed account programs are actually explicitly precluded from investing in less liquid strategies. So that's something, of course, we can pick up on as well, Paul. So I might just leave it there at this point.
Sure. So is the feeling that investors should have exposure in some way, shape or form in the retail space, the circa 1/3 of superannuation assets that probably don't have a lot of exposure in the same way as they do in those pooled structures? Is that a feeling that ideally we should, and as an industry, we should try and move the gears, move the controls to enable it? Perhaps
Yeah, I mean, I think we can. I mean, I think it would be good to do. I understand that there are practical issues associated with that, and I'm sure we'll get into those practical issues. There are cost-related issues, there's complexity issues, but I think that, you know, many of those can potentially be dealt with over time. It's just a question of, I guess, having the will to do it. We certainly philosophically would like to see as broad a base of investors having access to these types of strategies as possible.
Sure. And John, obviously you've got a solution, whilst not perhaps pure, is an enabler in the managed account world. Perhaps you want to talk to that.
Yeah, sure. Well, I mean, I think first I'd just say I completely agree with what Michael just said. I mean, I think fundamentally what we're talking about here are attractive assets which can offer compelling benefits to a broader portfolio, whether that's an institutional investor's portfolio or a retail investor's portfolio. I mean, there's a reason why Aussie super funds, global pension funds and the like have embraced this type of assets so enthusiastically over, I think, what's now quite an extended period. I do think that the way in which you access the assets has implications, and it's important for investors to obviously understand those implications and ensure that they're compatible with the investor's circumstances and in the broader portfolio. I mean, as an investment manager, I think you know, one of the things we seek to do is deliver investment solutions that meet the needs of the clients, and certainly. One of the things that you know, we've sort of been focused on for many years now is the fact that we believe that unlisted infrastructure has a series of characteristics that offer some, you know, attractive benefits to a retail investor's portfolio, but at the same time we do acknowledge that, you know, there have historically been some challenges for you know, small or retail investors to access them, and you know, two of the obvious ones are the assets tend to be quite large in size, and typically there's a fairly significant capital outlay required to access them. And then also to, as we've sort of touched on, you know, the liquidity angle also. And so I think, you know, basically what sort of, you know, can be done is access can be provided via vehicles which are designed to address those challenges. And so with regard to our solution, I mean, it's a vehicle called the Dexus Core Infrastructure Fund, which is designed specifically for retail investors and to provide them with access to unlisted infrastructure. As you say, it's not a completely pure solution in the sense that it does provide exposure to unlisted infrastructure assets, but it also does have an allocation to listed infrastructure to provide liquidity. Interestingly, I mean, this fund has been around since October 2007, so it's got a circa 17+ year history. The fund's priced daily. We accept daily applications and redemptions, and it's available on all the major platforms. And it actually sits within a number of managed accounts. So I absolutely think there are ways in which it is possible to make unlisted assets available in the retail space.
And Michael, you know, as a asset allocator, you select investments and so forth. What solution do you look at? LICs, LITs, and other, I suppose, wrappers that enable, I suppose, the retail client through an advisor to access private assets?
Yeah, look, I mean, they can all fall within the remit. I mean, I must admit we are a little bit cautious about LICs and LITs from the point of view that they can have significant fee loads, and fee is something that I think you know, we do need to consider. We can have very good strategies potentially available, but sometimes the transmission fee through to the retail sector can be quite significant, and it starts to negate the potential benefit that you're trying to capture by actually investing in it in the first place. So, you know, I think that there's a number of mechanisms that are being brought to market that I think are improving the situation. We're seeing fund managers coming to market with feeder funds or wrappers, as you're talking about. We're seeing intermediaries coming to market where they're really engaging with the fund manager and the end client or the advisors and intermediating a trust structure. But I think also it's potentially about getting our head around the fact that actually illiquidity is not necessarily a bad thing. can we actually manage illiquidity? And that's managing the expectations that retail clients have, and even wholesale clients for that matter. A family office, may have very similar expectations, by getting them around the idea that actually some degree of illiquidity is not bad, and hey, it's actually not too different to what you experience with your own residential property, but hey, you're getting a bit more diversification with it. That's sort of an education piece. So, I think that there's probably a number of touch points that we can probably, as an industry, do a little bit better at in terms of delivering better quality solutions overall, which may incorporate some of these illiquid strategies.
So you touched on the education piece. Are there things that we can do better on in that position? And perhaps can we, dispel any myths or misconceptions and, I suppose beliefs that are out there that these aren't assets we should have, or, I can't have illiquid assets in my portfolio, or as an advisor, I shouldn't have illiquid assets in a client's portfolio. Are there things that we can work on to dispel all that and get a better understanding both at advisor level and in the world of the client?
Look, I think there is. Obviously, advisors are in the position that they know their clients best, and individually they're tasked with the responsibility of providing recommendations that are in the best interests of their individual clients, and having that read. And maybe there are some clients that at the end of the day are in a position that they probably, by virtue of perhaps not fundamentally understanding the types of strategies, so the complexity issue, maybe, it's just not appropriate for their circumstances where these types of strategies perhaps shouldn't be used. That's the advisor's call. I do think, however, that in many cases, perhaps we're precluding access because we don't have the right wrappers in place, or the right access structures in place available. And perhaps there's an education piece that, in fact, as consultants, we owe to advisors as well, that, advisors shouldn't be recommending anything to clients if they don't understand it. And clearly they have an imperative to be educated also in this process. So I think everyone can probably do a little bit better in improving the education piece. And then it's just the facilitation. If people are genuinely interested, they understand the role that these strategies can employ within a portfolio. How do you actually make it happen? Now, John's outlined, a particular strategy from his point of view. There are other strategies out there that try to nut this out in a similar manner by blending illiquid and liquid components from the same asset class. Maybe, you don't need daily liquidity. Maybe we're asking too much from some strategies at the end of the day.
Sure. And I suppose that goes to, the technologies and so forth. So, John, do you see challenges from platform providers, superannuation funds who say, hey, you've got a product that's daily liquid, but roughly half at any point in time is unlisted infrastructure, and obviously the business also has the unlisted property similarly. Are you aware of any pushback from superannuation funds and investment platforms that have concerns around that piece?
So probably in some quarters, yes. The fund is available on all the major platforms. So I think broadly speaking, it's kind of been embraced, albeit there certainly are some providers, for example, in the managed account space, as Michael sort of mentioned before, who choose to not invest in illiquid assets. That said, we're aware of a number of providers, and indeed there are a number that use our vehicles that do use sort of unlisted assets. Certainly liquidity management is a key focus for us. As I mentioned, we do have that allocation to listed, which provides liquidity as well as other benefits to the fund. But we also sort of pay a lot of attention to how we approach liquidity on the unlisted side of the portfolio. So, for example, we have exit options identified for each of our unlisted exposures, which are regularly assessed and re-reviewed. And we also put in place some mechanisms to essentially enhance liquidity, such as, for example, put options over a number of our unlisted assets. stress testing is a sort of a key component of our approach to provide forward-looking views on what might happen in a particular range of circumstances, so that it gives us the ability to plan for different contingencies and that kind of thing. So I think there are sort of mechanisms that you can employ to look to enhance your approach to liquidity. But that said, to go back to your question, Paul, I mean, I think, from what I've seen is that there's a bit of a mixed bag out there. Some people do indeed embrace, the inclusion of unlisted assets in retail portfolios and indeed in some managed accounts. Others, it's a bridge too far at this point. And then I think in that regard, we probably go back to what Michael was talking about before, which is around that sort of education piece. And I think it's incumbent on all of us in the industry to ensure that investors have clarity and a good understanding of what they're investing in, whether that be unlisted assets or anything else for that matter. And that, clearly includes a good understanding of the benefits of investing in unlisted assets, but just as importantly, also the risks associated with doing it as well.
Sure, it is interesting because that 2/3 of the Australian superannuation assets, circa $2 billion, these are doctors, these are hospitality people, healthcare people, building people, all in an industry super fund. And they probably don't have a lot of understanding of what they're invested in, but they're not advised into it. They just take it off the shelf. Is there in some ways a challenge from a regulatory perspective that perhaps because of the requirement to have understanding and convey understanding and be comfortable that your client has understanding, is that a regulatory inhibitor to this space? And if so, should something be done to sort of, I suppose, facilitate? And to what extent do people need understanding? I mean, BHP is a very complicated business. It operates in something like 80 jurisdictions around the world. They're talking about a big merger with a company in Europe or UK, which has just been knocked back. But that would add further complexity. But it is already extraordinarily complex, and they're talking about potentially whether it would be a target to take over Rio. I don't think retail clients fully understand all the equities in an Aussie equity fund. Is owning infrastructure any more complicated? Perhaps, John, do you want to talk to perhaps some of those complexities? Obviously, equity guys, and you've worked in the equity space as well in the past. But perhaps is there this mysteriously different level of understanding required for these assets?
Yeah, I mean, I think there's a lot in that question, Paul, and probably the first comment I'd make is that, obviously there's a regulatory framework that applies in the retail space, and that framework applies for a reason, including to protect the interests of investors. And so I think it's I don't necessarily see it as an inhibitor per se, but it is a function of if you want to sort of work in that space, you need to sort of work within the rules. And then just fundamentally, I think, at the end of the day, as an investment manager, we're investing other people's money. And, to my way of thinking, that means they've got, every right to full disclosure and full understanding of what they're investing in as well. And so that then perhaps comes back a little bit to two things. I think one is, as Michael was referring to before, advisors have a really important role to play. At the end of the day, every client is going to have different circumstances, different needs, different wants. And I think the advisor's role is critical in determining what will, and just as importantly, what won't work in the context of, that investor's circumstances and in their broader portfolio. I think it's incumbent on us as investment managers to do a few things as well. One is, and we've touched on it already, but to continue to focus on that education piece. I think that unlisted assets in some respects have probably been a little bit in the too hard basket because they haven't been so broadly accessible in the retail space as for example, listed equities and the like in the past. And so I do think there's a bit of a catch up in terms of, people understanding, sort of what they might look like. So as investment managers, I think, we've sort of got to sort of play that educational role. I think we also have a responsibility to listen to advisors and clients and really understand what it is that they need and they want, and then to look to structure investment solutions that meet those needs. And then on an ongoing basis to support advisors and investors with information, materials, answers to questions, and so on. You sort of asked the question, Paul, about whether an infrastructure asset, for example, is more complex. And within the infrastructure spectrum, there are assets which I would classify as very complex and assets that I'd classify as pretty vanilla. But that's the same in sort of other asset classes as well. And for example, that BHP example you gave, I think was a pretty good one in that regard. So we're actually investing in the same types of underlying assets, whether we invest in them through listed markets or in the unlisted form. So you've got your sort of investment level stuff, which is important for people to understand, but it's really around sort of the implications of the different forms of access and what that means for investors and how that might impact them, and the considerations that throws up when considering whether or not to utilise that means of access in their portfolios.
Sure, Michael, what are your thoughts on the regulatory side that perhaps may inhibit or may not, and these complexities, issues and understanding of the assets vis-a-vis equities or even bonds? I mean, they're not the simplest assets. So it's a bit of a myth that there is more complexity here than other parts of the market that we buy every day.
Oh, look, I take your point. With a complex structure like BHP, no one's going to understand all the underlying assets. I don't think an advisor is going to be blamed by the regulator for putting people into an Australian equity portfolio that happens to hold BHP. I mean, it is commonplace investment. However, if you start to look at idiosyncratic investments in the alternative space that aren't very commonly used by others, then I think that there is probably a higher burden of proof. Whether it is more complex or not, there is a higher burden to say, well, that is actually applicable for my clients, and it ticks all the boxes, and that does require, I think, a level of understanding. I mean, it is true that most investments, to a large degree, is a bit like owning, a modern car. You lift up the bonnet and you really don't understand what's there. I mean, it is far more complex than it used to be. Nonetheless, the structures might be more complex. The diversity of investments undertaken by individual companies, let alone individual strategies, are more complex. But I think there's probably a common sense test here that if everyone's using an Australian equity investment, passive or active, they're going to have investments in a wide range of Australian companies. They're not going to understand the underlying mechanics of it. No one's going to blame them for having exposure to Australian equities. If you start investing in, some quirky alternative assets that at a point of the cycle freeze and refuse to provide redemption, then that's when you potentially have to answer some questions as to what was the rationale putting clients into it, whether it's the regulator asking you or whether it's the retail client asking you. I mean, I will say that you talked about risk of alternatives or illiquid investments, and mentioned that previously. We manage a range of managed account strategies that are tailored for individual clients that we deal with. And we've got strategies within that space where the client, being the advice practice, is very comfortable with alternative investments. And they have a type of investor. Quite often it's an older investor, perhaps entering pension phase, that are particularly downside sensitive, and they want strategies that are providing diversification away from traditional equity beta risk, which is your biggest risk within a conventional portfolio. And so they're very open to, investments in the alternative space, be them hedge funds or insurance-linked securities. They might be very open to investments in the infrastructure, direct property space, because of the benefit of dampening the downside risk within portfolios. And that's great. The quid pro quo for that, however, is when you go through a period like we went through in equity markets over the back end of last year and the first few months of this year, those portfolios lag behind. And so advisors are in a situation, that the portfolio is doing its job by dampening volatility, but now the volatility is on the upside and clients are asking, well, why is this appropriate for me? So, that I guess is a risk of not producing market returns in line with a vanguard strategy that has no exposure to these types of investments. And of course, industry funds suffer this problem all the time. They always lag on the upside and they tend to lag on the downside, or they deliver better cushioned returns on the downside. So you've got to understand what you're delivering and whether it's appropriate for your client. For other portfolios we manage, that are perhaps for early stage accumulation clients, they don't necessarily care too much about volatility. Their drawdown phase is so far into the future that, maybe some of these strategies have less relevance for them. So I think it's about knowing your market, and the advisors are in the best position to understand that.
Sure. We've got a question from the floor or from the audience. Are there investment areas which you view as particularly risky? And conversely, what are the opportunity sets that, where are assets that you can use in the managed account space that, there is a reasonable level of comfort? So what's risky, particularly risky, versus what is opportune and available for this space?
Particularly risky end of the spectrum, I guess, would be single strategy hedge funds, strategies that are employing, significant leverage within their portfolios, depending on what the leverage is being used for. I mean, they will probably be at the riskier end of the spectrum. And that's, inherently no different to leveraging up an equity portfolio from that point of view. At the less risky end, you're talking about, direct assets investment, whether it's infrastructure, commercial property, private equity. They tend to be a little less risky, or at least appear to be less risky, because of the mark-to-market effect as one characteristic, because you're not valuing them every day. They'll tend to have less volatility associated with that. Now, inherently, the assets might be less volatile, but it might also partly be because of the less regular valuation cycle that those assets go through. So, just look at the comparison between listed infrastructure versus unlisted, or listed property versus unlisted property. You can see that, while they may invest in different underlying assets, they're in the same asset class, but they have vastly different volatility metrics. And as a consequence, that a lot of that is due to that mark-to-market effect.
John, have you got anything on thoughts around what is particularly risky, maybe even within the asset class of infrastructure, but versus what is less risky?
Yeah, look, I think, probably I'd just sort of agree with what Michael just mentioned. And I think as he was speaking, what that sort of made my mind go back to was what we're saying before about, the need for people to really understand the characteristics of what they're getting into, so that they can make informed decisions. In terms of, sort of risk, within the infrastructure asset class, there's a range of different types of assets which have different risk profiles. There was a sort of I guess a bit of a buzzword that was thrown around a lot, a number of years back, when interest rates were much lower, about infrastructure being a bond proxy. I was always really uncomfortable with that, because I think that there are perhaps some types of infrastructure assets that have some similar characteristics as a bond, but there's a lot of other types that have characteristics that are vastly different. I was always sort of quite concerned, I guess, that terminology which was thrown around in the media a lot would give people a sort of an incorrect perspective on the asset class and the risk profiles that you're exposed to. Within the infrastructure asset class, talking high level, you sort of probably lower risk assets tend to be things like government-backed public-private partnerships, where you have often a government counterparty. You have often availability-based revenues. So as long as you make the asset available to the government for use, you get paid. Your operating costs are generally fixed over an extended period as well. So there's not so many moving parts in an asset like that. And then you come up the risk spectrum to the assets that are more economically exposed. So, for example, things like airports, for example, and seaports, which are very much driven by the number of passengers that transit through the airport, the amount of cargo that's transiting through a seaport. And so with those assets, you're taking on a higher level of risk. And of course, you'd expect a higher level of return to compensate for that risk. But, again, a different risk profile to something like a PPP. Probably the other comment I'd just make there is, which I don't think is always all that well appreciated, is that infrastructure is very much a heterogeneous rather than a homogeneous asset class. So, every asset is different. And assets that sort of look the same on the surface might actually be subject to very different underlying drivers of risk and return. And similarly, it works the other way as well. So assets which might look different on the surface might actually be influenced by similar factors. So, for example, you might have an airport here in Australia and a toll road in Europe. And on the face of it, you've got two different sectors, two different geographies, but both of them might be, for example, influenced by, say, oil prices. And so you do need to sort of be mindful of not just sort of top-down sort of measures of diversification and risk, but also really understanding it from a bottom-up perspective as well.
You've highlighted a few points here that I think are interesting. So in terms of interest rates, obviously we've had a significant move in interest rates. So is that being, I suppose, something that the market is saying, oh, well, I don't want to invest in private assets kind of more broadly? Do we get a sense whether the move in interest rates has put investors off? And the other thing, just backing up a little bit, was that, when we talk managed accounts, we actually uplift who is responsible for the investment decision. So in a managed account, I'm not actually recommending this underlying asset. That's done at portfolio level. Someone's recommended, or I've recommended, the actual managed account portfolio. And to that degree, you do not have to explain how an individual private asset fund, unlisted infrastructure, whatever it might be, to the end retail client. Obviously, it's got to be suitable and appropriate and all those sort of things, but you've lifted up, and to me, some of the benefit comes from that. So the first question around interest rates, and then the decision makers, are we seeing what they're doing with these sorts of risks and issues as we've transitioned along through the last sort of 18, 24 months?
Well, maybe I can sort of start with the first one, Paul, and I can have a crack at the second, but Michael might have some helpful views there as well. I think in terms of interest rates, I mean, infrastructure and real estate, for that matter, are kind of, sort of more yield-sensitive asset classes. So an environment of rising interest rates, of itself is not all that particularly, sort of helpful. So that has been a bit of a headwind for those asset classes over the last few years. I think, looking forward, we're hopefully at the top of the interest rate cycle, although inflation does appear to be sticky. But if and when rates do start to fall, I think that will be positive for the asset class and for valuations. Probably the other point there is that, even if rates stay stable, that's actually not a bad operating environment for infrastructure, because current rates are fully priced into valuations. I think the other point there is that there's a myriad of factors which influence the valuation of an infrastructure asset, whether it's in a listed or unlisted form. And often you'll see a range of positive influences on a valuation and a range of negative, and it's ultimately the net outcome that's what is important for investors. And so, if I look back over the last few years, we have certainly seen discount rates pushing up as a result of increasing interest rates, which is negative for vals. But then on the flip side, we've also seen some positives coming through. So, for example, many infrastructure assets have their revenues indexed to inflation. And so what we've actually seen is that with a lot of assets, we've seen an increase in revenues coming through as a result of that inflation indexation, which goes some way to offsetting the impact of the rising interest rates. Range of issues that can sort of have an impact. I think in terms of what we've been seeing, I mean, I think about, I'm sort of out reasonably regularly talking to investors in the market, and a theme that I've, sort of heard a fair bit over the last sort of, it's probably, where are we now? We're in sort of almost in May, probably the last sort of 9 months or so, is that people had been holding off allocating to yield sensitive sectors because of the fact that they didn't have confidence at that point that, inflation was coming under control, and likely that, we'd reached the top of the interest rate cycle. And I've had a number of people say to me that, once we're comfortable interest rates have topped, then that's when we think it's appropriate to start allocating. I think sort of generally speaking, sentiment that I've picked up on over the last 6 months or so has been more positive than it was, last year, which I think is good. I mean, obviously there's, still a lot of moving parts and a lot of risks out there. But as a general comment, I feel that sentiment has shifted or is shifting somewhat.
Yeah, look, and picking up on a couple of those things without repeating, I think the interest rates of themselves are important, but you've got to have a mindset that it's part of the story. You've got to have an understanding of what's happening on the earnings side, or whatever asset class you're looking at, whether it's listed equity or private equity or infrastructure. You can potentially endure a situation of rising interest rates, which affects the discount rate, if the earnings outlook is actually commensurately improving. And a case in point is, what's happening in global equity markets. I mean, we've seen a pretty steady backup in yields over the course of the last few months. But our global equity research team has taken the view, well, actually, that's a function of a global economy, and particularly a US economy that's actually still reasonably robust, and the earnings expectations are being met. And in that sort of situation, it's perhaps not a rubber band you can stretch forever, but it actually provides a significant offset to that rising interest rate story, at least over the course of the next few months. So I think that's the same logic you can apply to illiquid asset classes as well. I do think that, probably one thing different in the illiquid space is that valuers, have some discretion as to the valuation cycle, and often it is significantly affected by the observation of transactions. And when you are in a period where transactions are pretty lean, the valuation gap that is being applied to different assets can often be quite wide. So it's not just having a macro view of the asset class, but actually understanding what is the valuation metric that is being applied to particular assets that you may potentially have exposure to or currently have exposure to. That's pretty important as well. And I think we're in a period that perhaps that's unusually wide at this point in time.
Sure. And one thing we haven't talked a lot about is on the defensive asset side, private debt, private credit. Just a quick one around that. Is that something, I mean, certainly at SQM, we're seeing private debt or private credit funds coming to the market for ratings, almost weekly, I would suggest, not quite perhaps. But Michael, what are you seeing in that space? And then as you talk as a consultant to your clients, is that an area that they're feeling they need to have or want to have because of the yields? How do you see that space?
Yeah, look, it's both an opportunity and a risk, and I'd be interested in your thoughts on this too, Paul. But as a researcher, we're certainly seeing a lot of managers coming to market and coming to us with private credit offerings. I think that's great, and I think there is probably a general underinvestment in that space at this point in time. The concern we have, and I have, is that private credit does have very specific and detailed credit research requirements to effectively do it. You're not relying on a fund manager, you're not relying on a rating agency having rated every bond in your portfolio. You actually have to go and rate each of the assets that you put into your portfolio. Generally, you have a lot less diversification of those assets in your portfolio. Some of these private credit strategies have, particular skews to certain sectors. And when you look at it from a total portfolio perspective, if they're getting mortgage asset exposure, well, you're also exposed significantly to the banks. You've also got fixed income in your portfolio elsewhere that might have exposure. You might be invested in hybrid or subordinated debt. So there's a lot of thematic build up in the portfolio around some very specific risks that John was talking about previously, factor risk. So I think it's a cautionary tale that we are very selective about the managers who we believe have the right type of portfolio structure and the right type of experience to manage a private credit book at this point in time, notwithstanding the fact that it is sort of turning into a bit of a gold rush out there.
Yeah, I think from our perspective, what we're seeing is a group of managers bringing products for solutions into loans that the banks or the individuals don't want to use the banks, or the banks won't loan to, not because they're bad credits, but because they're different credits. They're not PAYG, boring home loan for 700 grand, 800 grand. They're a whole lot more complicated with some sort of development, maybe a business behind it. A lot of them are property oriented. And I get a sense, and I've read articles that suggest that it might be just a lot of lending to rich people to do fairly expensive, in terms of dollars, not from a valuation perspective, spending a lot of money on bigger projects that need to be funded. And the sense is that there may not be a whole lot of risk in this space if that is true. So one of the challenges I think we have in this space is understanding where the skeletons are in the closet. Is there just one or two skeletons in everyone's closet? Or are there certain managers who are a little bit loose and lending to credits that actually aren't that good, even though they say their credit processes are very good and they go and explain it? And so I think that is one of the challenges from the market perspective as a consumer or even as a research house rating them, is trying to work out who's got skeletons and who doesn't. And I do get a sense that, a lot of these people are well experienced, having worked in banks and in that space, and actually have quite good credit assessment processes. They're not relying, as you said, on S&P and Moody's. They're doing it at a more individual level, less at the larger business level, and often secured in some way by often property, but also other assets if they're asset backed. So yes, it is a very interesting space that we're seeing as well. I think
it's a space you've got to really understand the covenants that are being applied to a lot of those loans. So, it is very beholden on the fund manager to have, that level of detailed understanding and hands-on management of the portfolio. And, as a consequence, we're not assessing the underlying loans, we're assessing the capability of the manager. And there are some very good managers in that space, but we are very selective about it.
Sure. If there are any last minute questions, key them in. It's been an interesting conversation, and there's a lot of assets. We haven't gone really to specific asset classes in the illiquid markets. Obviously, we've touched on infrastructure and more broadly with Michael's consulting hat on. The space seems to be underrepresented. It does seem an opportunity for further diversification in a lot of portfolios. Do we think we can put pressure on platforms that enable managed accounts and SMAs particularly? Do we think there is space or opportunity to put pressure or influence them, not just us, but the advisors and the broader community, to perhaps enable this a little more?
Yeah, look, if it was as simple as that, I mean, I think it would be potentially a reasonable strategy. I think it does come down to the inherent illiquidity and how do you deal with that within portfolios, or does that even matter? How do you rebalance a managed account portfolio when a reasonable slice of it is actually completely illiquid? That does produce certain complexity. It produces complexity with rebalancing. It produces complexity for handling individual client cash flows. And so I don't think it's just a case of, putting pressure on the platforms. I think that's part of the equation. I think the REs that are actually managing the portfolios. You've got to get them comfortable with it. You've got to get the end clients comfortable with it, because, you know, inevitably, if part of the portfolio is illiquid, and they need to draw down money at a point in time, then telling them, well, that's great, but there's going to be some constraint because a part of the portfolio is locked up for whatever reason. You know, they've got to be forewarned about that potential and be comfortable with it. So I think it is you know, it's a probably multifaceted issue. And I know a lot of work's been done by IMAP and others to try and nut this out. And we'd certainly be encouraging that evolution and development of capability. But we're not there yet. That's the reality. We've only got two sets of portfolios in our stable of clients that we manage that has any illiquidity in it at all. And that, you know, that to us is certainly an underutilization of what is an interesting opportunity set.
Sure. I think we're just hitting on time. So, Toby, excuse me, any other last comments to finish up?
Yeah, no, thank you very much, and thank you, Michael, for the plug. Yes, this issue of illiquidity and being able to accommodate assets that may be illiquid for individual clients, let alone because of the underlying nature of the investments, is an important one. So, Paul, thank you very much for your role today. Michael and John, thank you for what's been a very interesting conversation about the opportunities and issues that illiquid investments, infrastructure, and others offer to advisors. This is going to become an increasingly important part of the way in which advice services are delivered to clients. So let's just remind you that tomorrow Paul will rejoin us to talk with Russell Pellimer and Zivan Wong from Pengana and MLC, respectively, two organisations which have been deeply involved in private market investments. And then on Wednesday, Chetan Trahan from SQM will join Lachlan Brumby from Russell's and Jason Petrus from Resonant Asset Management, talking about the way in which they address the issues which came up in today's session on incorporating private markets, illiquid investments, the non-mainstream investments into the way in which portfolios are managed. So just a reminder that in July, Advice in Action in Sydney and Melbourne, and for those of you who are operating or managed account portfolios, an opportunity to enter our awards for 2024. So thanks very much for your attendance and participation today. We'll look forward to having you join us tomorrow and Wednesday, where we continue this focus on non-mainstream investments. Thanks very much for that. Thanks, guys.
Thank you. Good afternoon.